Hello there. Today, on the 26th of July 2012, we have seen the National Treasury Management Agency, NTMA, make a second attempt to return to international capital markets with the announcement that they intend to raise money through a 3 and potentially as far as a 6-year government bond sale. While that is clearly positive in itself, it needs to be taken in the right context. In the view of our Talk Financial colleagues, we believe that it is as much a political move as it is an economic one, in order to try and create international market confidence, which is not really there yet. It is not really the raising of new investor debt that these bonds are aiming for. It is in fact the deferral of maturing bonds over the next 18 months or so, in the event that the Irish government and the NTMA are able to defer those bonds to 2017 or 2020 with a reasonable yield, it might be said, of 5.5 or 6%. It takes pressure off us next year when it comes to raising money, bearing in mind that the bailout fund that is currently in place within Ireland will come to a close in December 2013, and obviously Ireland needs to be actively back in the international capital markets before 2013, well, before December 2013, and therefore it will be our view that this is an effort to create a belief within the international market that we are confident of coming back in, and that we have got market confidence to raise new government debt through the issuing of new government bonds. That's not really quite the case, however. This particular bond auction is more to do with the obtaining the agreement from existing bondholders to effectively defer the maturing date on their bonds to 2017 or 2020 with a new yield agreement coming into place. Will it be successful? I would imagine it probably will, because the National Treasury Management Agency would hardly go to the market without having first spoken with the existing bondholders, making sure that they would have the support. It would be not only highly embarrassing, it would be highly damaging to the economy if this particular bond auction was not fully subscribed. So I would imagine that it will be successful, but it should not be interpreted as meaning that the international market is voting in confidence in favour of the Irish economy. Internally to the Irish economy, we still have several other concerns, from exchequer revenue and exchequer expenditure, which is still in the order of 20 billion a year, higher than what it should be. We still have employment teetering on the brink of 15% in spite of immigration. We still have a major credit flow problem, despite banks advertising their openness for business and their willingness and interest to lend money. That is really a spin by banks to keep the Irish public at bay and to keep the Minister for Finance under the illusion that credit is freely and easily available. It is not. Banks have money, but they're not willing to lend. As a consequence of that, there remains downward pressure on property values, despite all these indices that have come out in the last 6 to 12 months saying that we have probably arrived at the bottom of the property market. We in Talk Financial are constantly saying that is not true, because you need a balance between demand, credit and supply, which we have yet to really achieve. Property market is still falling in Ireland and will fall, albeit at a relatively slow rate, but it will fall for at least the rest of 2012 in our view, and will not start to recover until credit flow starts to become more apparent. Having said that, there is a well of interested buyers, and therefore once credit does become available, it will be our view that we may well see an uplift in property values initially that will be higher than the rate of inflation, as the well of interested parties gain access to credit and start to buy up. So we would view that in 2013 we will probably see a bottoming out of property falls, followed by potentially a reasonable recovery in low single digit figures, as credit lending comes back to the market, and that will eventually balance out, whereby property growth will recover in line with inflation around 2015-16 in our view. Globally, there's still major worry in Spain. It is now rumoured that the Spanish economy may well need upwards of 500 billion euro in bailout monies. In the event that Italy was to require a bailout, it would be even bigger. And those two countries alone put an enormous shadow over the whole concept of the European Stability Fund and its ability to shore up the survival of the euro as a currency. Greece is by no means resolved, and indeed we are now looking at the possibility of a ratings downgrade of the German and Dutch economies, primarily based on their exposure to the likes of Spain, Italy and Greece and the financial institutions inherent to those economies. Therefore, our message really is to go back to the main topic regarding the National Treasury Management Agency's re-entry into the bond markets today. It is not as positive as it might appear. There is a little bit of political gamesmanship going on in our view. Both nationally and internationally, there are still major economic fundamentals that remain unbalanced. And until they are resolved, we will not see a sustainable stability return to our economy or indeed to global equity markets. Therefore, be careful with your money, be careful where you invest, beware of the fact that the vulnerabilities that are out there reflect a genuine opportunity to make money, but you must understand the risk. You must be willing to tolerate the potential for losses in order to make the money, or in order to make the gains rather, and you must be fully aware of what you're doing. Until next time, thank you for tuning in. Bye-bye.